Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated, which is every market that we see now, the ripple effects and how the precious metals react. But it's good to all three be together again. Miles, thanks for carrying us last week.
Thanks for holding down the fort.
Welcome back,
Yep.
boys.
Yeah.
Appreciate it.
Yeah.
Missed you guys last week. I was just joking in here. It's not easy. You know, it's funny. I had a pastor once tell me, hey, if you're going to preach for an hour, prepare for an hour. But if you're going to preach for 30 minutes, prepare for 2 hours. If you got to talk for 15 minutes, prepare for 4 hours. So that 12 minutes all by myself last week was not easy. So I appreciate seeing both of you guys back in the building.
I keep trying to tell you, Miles, just take 10 pounds of mud and stuff it in a 2-pound sack. 10 pounds of mud, 2-pound sack.
There you go.
Rob, you've been telling me
master.
for years I'm more of a 30 pounds of mud kind of guy. So, and then I overflow the sack. Well, welcome back, guys. I had just sort of a what's going on in the world recap show last week, just because gold was parked right in this trading range. But one thing we've been talking about for a couple weeks is when you have a compressing trading range, when you have what we call a pennant pattern, eventually you run out of runway. And guess what happened today? Today, Wednesday, we ran out of runway. So we're going to talk about a potential gold breakout to the
upside. Finally.
Exactly.
It's about time.
Little potential gold breakout to the upside pending here, and some of the levels we're looking at. Silver falling a little bit behind. We'll get into that, but we've also got some pretty big announcement on the economic side that we want to go through. So this is going to be a pretty heavy show today.
Yeah, I think gold actually is very encouraging, and especially in the instance where there is no rate hike. So we can jump and talk about why is gold doing what it's doing. Fed did pause today, so the FOMC occurred. They had their September 19th and 20th meetings, and they did say, what, Rob, they're going to keep their thumb on it, really watch.
Oh, yeah, they're going to watch it like a hawk.
Yeah, not like a dove.
Not like a dove. But, you know, in 3 more years, our national debt's going to be pushing $50 trillion, not 33, at the rate we're going. And the interest on the national debt's going to be $2 trillion instead of like $1 trillion where it is now.
And there you go. I mean, that's part of why it's up. They've got the discussion with whether or not the government's going to be shut down here, all this talk. We know that isn't going to happen. But this is the second time that they've paused, so they're clearly seeing some things that are encouraging them to pause. But 12 Fed officials see another rate hike this year. 7 officials see no more hikes, and that the chance now is a 50% chance of further rate hikes. But they do say that the interest rates will stay higher for longer. And to me, there's too much to talk about today, really. I mean, in terms of that, but also with energy and other markets. But trying to circle back around to gold, the thing, Miles, that surprises me the most is not just the breakout, because we've kind of talked about seasonally seeing that this time of year, right? But the dollar index. One of the things we point to on this show a lot is the non-correlation, or actually the inverse correlation with the U.S. dollar index. And that's been phenomenal. So for gold to be up with the dollar index being so much higher, that's encouraging for the gold owner.
Well, and also with interest rates much higher over the last few years, gold has responded. Gold's supposed to go down as interest rates rise. Gold's been going higher for the last 3 years as interest rates have risen substantially.
And bond yields. Gold's supposed to go down as bond yields rise. And bond yields have gone from 0 to 5%, essentially. And gold here is now at just under 1950. So what are your technical numbers, Miles, that, you know, as we get into the details here of the breakout, and are there numbers that you're looking for now that would either confirm or deny this breakout?
One thing we're looking at is you don't have a confirmation of growth until you at least exceed some of the previous highs on our way up to the all-time highs. So currently our most previous high just goes back to end of August, beginning of September. That's the around 1960 we put in. But the big number I'm looking at was the summer at 1988. And I know I've mentioned 1988 before, so I would argue, you know, we see 1990, 2000 again, we're probably off to the races, because there isn't much between 2000 and 2100 where now we're at new all-time highs. So why would I be arguing today that we're seeing a little bit of a breakout pattern? Well, it's because it's in comparison to, say, what we saw in the US dollar here recently. We do have these compression zones that tend to bring any market, in this case gold, down to kind of a central point between highs and lows, where highs are stepping down while lows are stepping up, and you end up finding an average price in between the two. In the case of gold, where we started in March, down around 1800 and ended in May or June when we hit previous all-time high 2100. So then you end up compressing between those two numbers. Lo and behold, we end up somewhere right in between the two, right? Like low 1900s, and it just gets tighter and tighter and tighter until you see it break that line one way or the other. And we'll look at that and how the dollar did it a couple weeks ago. Come back and get a nice little retouch, which would be the next signal we're looking for in gold. And then we got to get up to that previous high of 1988, which was a little bit earlier this summer. So that's going to be my signal at that point, as far as I think we can start arguing the long-term pause that we've been looking at here over the last 6 months or so, gold coming back down, that's probably over and we're on our way back up. Now, am I waiting for 1990 to make my next gold purchase? No, I buy gold every 2 weeks. I've been doing it for years now. And from time to time, when we get a breakout move, like say we had today, if I can scrape a little bit more cash out of the couch cushions, I'm probably going to pick up a couple more ounces today or tomorrow.
All right, so we'll be watching for that next breakout and see if this break above the pennant formation holds. And yet at the same time, we're going to have eyes on the US dollar index. Normally that would give us the opposite direction, but you had even said the chart looks similar. So what's your theory here on what's going on with the gold price in relation to the dollar index spike?
Sure. Well, here's a great example of what we just talked about. You can see back in August, we had this similar type breakout where we had this compressing zone. Dollar broke above it. We came back and touched the zone. So old high becomes new low. It's like putting your foot on the next stair step on the way up. And we've stair stepped right back up. Also, what I love about the dollar, it's fitting in between the Fibonacci levels perfectly. We went down to the 618. Now we've come back up and touched the 382. So it's using these just like a flight of stairs as it steps its way up. And I think we're going to see gold do the exact same thing.
Right now, the dollar is bumping up against its 2023 highs. Now, we were higher a year ago. Do you think the dollar is going to break above 105.5?
Yeah, I think there's a very good chance that we see the dollar break above 105. And here's an interesting correlation between the dollar and the gold, is that 105 number for the dollar is kind of the last line of defense between 105 and the previous all-time high last year of 114, 115? That's the exact same thing I said about gold at 1988. So to me, it just looks like the dollar and gold are working side by side, or maybe the dollar's a couple steps out front of gold as far as making those moves a few weeks ahead of gold, but they're doing the same thing right now.
Yeah.
Dollar rallies are actually very concerning. So you got to keep in mind, I mean, not that dollar declines aren't concerning, but the dollar rally, to me, that's also a risk-off asset in a sense,
Has to
right?
be.
Yeah. So when the stock market crashes, for example, the dollar skyrockets.
Right.
And I'm not saying, we're seeing the equities markets, the NASDAQ and the S&P down 1% today. So that's fine. There's a little bit of a correlation there. But I'm talking about if the dollar were to break out, not raising interest rates is not strong dollar policy. Raising interest rates is strong dollar policy. So they paused and the dollar's up. So what that's telling me is the world is getting more and more concerned, and there's more and more people just moving into cash positions. Why are they doing that? I'll tell you, the last couple of weeks, you guys, I've been on the road at different events, and 2 of them were real estate in emphasis. And those who are in the inside know and have admitted that the top is here in real estate. So are people selling assets, moving into dollars? Are they taking this equities market opportunity of kind of recuperating what was lost in 2022? 2023 has given it back. It's not believed. So now we're starting to see more assets moving into cash again and gold at the same time, right? Our business hasn't slowed down.
No.
So if everything's so rosy, why wouldn't our business be slowing down? Why wouldn't the dollar be turning down and reacting the way it should to interest rate pause?
Well, I think the average mindset has changed a little bit. We no longer talk about diversification in terms of like asset classes. Oh, I've got my stock portfolio and my bonds and my derivatives and my money markets and real estate and yada, yada. What we talk about nowadays is something I think we've been talking about as a company for 50 years, and that's diversification of purpose. What's the old saying? I'm not concerned about getting a return on my investment. I'm concerned about getting a return of my investment.
Yeah.
So we've gone from this situation where we're looking at diversification within one purpose, the idea of growth and return, and then how many different types of asset classes can we invest in that all provide varying tiers of return, into what can I go into that's going to preserve my purchasing power going forward. And real estate and the equities market has been kind of the two biggest, certainly here in America, those are the two biggest investment classes for long-term growth. Well, what happens if real estate is looking at facing a probably 15 or 20-year interest rate cycle, because that's how long interest rate cycles last, and the equities market, which has been propped up through derivative products and then borrow investing, what happens when that tops out? Where do you find returns? And are getting returns even a possibility nowadays, other than just sitting in a treasury bill money market?
That's it, right? I mean, the one benefit is that you have the return in money market and treasury-backed securities, in a sense, where you can get 4 or 5% on a short-term, even short-term CDs.
Yeah, but that's still not keeping up with the cost of living.
Or inflation. The real inflation, according to John Williams at Shadow Stats, is over 11%.
Right.
And we feel that in our pocketbook.
We do. And most of the people I talk to, they're focused on returns. They want to know, is it going higher? But really, to them, they're allocating to the metals market because they're losing faith in the financial system. Not so much trying to make a big killing in gold.
Absolutely.
They just want to keep it safe for the next 5 years and then look at what their options are.
And that's exactly what I told the real estate crowd. This is a market that is very loyal. These are investors that they know their trade, they stick to their trade, they go all in on their trade. And what I'm trying to show them is, look, if you just look at 2007, 8, and 9 as an example of how you could have diversified into gold instead of dollars while on the sidelines, if you know the housing market's going to turn down and you're liquidating properties in advance of that, and you're now in a heavy cash position, why wouldn't you be sitting in gold? We have a recent history here of exactly what transpires, and you end up with twice as many properties if you sit in gold instead of cash, especially in an inflationary market. So the Federal Reserve already told us today, higher rates for longer. We've been hearing that, but Miles, you're exactly right. They said that today. So if you're in a long-term interest rate cycle and banks are under increased scrutiny, you've had money leaving banks seeking the same yield we just talked about in treasuries or other, high yield return opportunities with cash, and they're not wanting to lend. Restrictions have increased in terms of lending. So the housing market has to naturally turn down. So wait it out. It's great. This is a perfect opportunity for you to move into gold, not cash, and let it climb. And there'll be a point where there's great value. Right, Rob? Just exactly what you're saying.
Yeah, because it's really a store of value.
Yeah.
Yeah.
And there's a non-correlation. So, Miles, you threw together some really good images here on just real estate versus gold. Over the last 20 and 50 years, each of those asset classes have done remarkably well. Gold has outperformed real estate, but if we just look at the single-family home prices here, and you can see, to be fair, let's look at the last 20 years because anybody listening to the show is likely more sensitive to what housing has done in the last 20 years. Well, these are both really powerful images. This is a strong climb in each market sector, very comparable to each other. But look at how the real estate trend line is just this zigzag. It looks like a zipper type of deal, whereas the gold has bigger swings for the most part, but a little bit higher climb. But the key takeaway here is there's no pattern. There's not a correlation between the two, which means it brings great balance. You'll see when gold is down, it can be in an increased housing value type of an environment. And likewise, when housing is dropping, you can see gold climbing. So it's not inversely correlated, but it is non-correlated very, very strongly. And it makes a great hedge, not only for your stock portfolio, but for your real estate portfolio. And we know what's getting ready to happen in real estate. Be prepared and be ready to weather the storm so you're not caught like you were in 2008, completely off guard.
Yeah, good point.
Well, and if you want to remain optimistic, as we tend to be, let's also not forget that your year-over-year CPI for the month up 3.7%, so higher than expected. And your inflation-adjusted household income is down 2.3%. So things continue to get more expensive. We've talked about real inflation numbers versus whatever the current math happens to be this week, as the government tells you what inflation numbers are and that difference. But the average income is also declining as well. So that has a multiplicative effect on your spending abilities going forward as well. So return of principal, not return on principal, to me seems to be the mantra going forward.
That's a really good point. And unfortunately, the government is celebrating right now that the job market is cooling. On top of all that, the central banks have driven up the cost of living. They've driven up inflation. They've driven up interest rates. So the cost of borrowing is higher. And, let's attack the job market. Let's drive wages down, and let's, in fact, get more people unemployed so that inflation cools. Yeah, that sounds like something that should be going on around Christmas time. But anyway, let's not forget silver, Miles. Before we leave the show, we're not going to let you off the hook with silver charts because it's had a little pop here too.
Yeah, it's had a little bit of a pop, but when you zoom the chart out a little bit, I think it actually emphasizes our point that gold is looking at breakout territory and silver's still at the bottom of its trading channel. This is not a growth and investment driven move in gold. This is a fear motivation. And I don't know if I want to use the word fear, but let's just call it what it is.
You're hearing it, aren't you, Rob?
This is a fear motivation.
So am I.
You don't move money out of a bank that you've had in CDs and savings accounts on a nationwide scale over to Treasury money markets at Schwab and JP Morgan and whoever. You don't do that unless you're concerned about banking issues, and we've seen that this year. You don't run the value of the US dollar up unless you're concerned about where the investment potential is. We're not looking at the decline in the average real estate pricing nationwide that you talked about a second ago, unless people are concerned where the real estate market's going. And the stock market hasn't been able to make any real ground in, 2 years now?
Yeah.
Again, I hate using the F word, fear, but it sounds like fear to me. And even in the precious metals, we're starting to see gold take moves up, but silver, which is an industrial metal and is primarily owned as an investment, not a hedge, it's not keeping pace with gold.
It's not, and the ratio climbed up to 84-1 as a result of that. So our eyes are on those ratios, constantly seeking value. And a lot of IRAs being repositioned into physical metals. I will tell the listener this. If you're acquiring off-market, non-standard product, stop it. Stop it, right? Rob, Miles, how many stories are we hearing of people overpaying high premiums and watching IRA values just plummet 40, 50%.
Or more
overnight?
Yeah.
Stop it. Think in terms of number of ounces for the dollar. Your whole objective is number of ounces, not the type of product. Don't go for some strange collectible, quote unquote, collectible product. Call us and we'll walk you through that. Let us save you from yourself in regards to somebody giving you bad advice. So,
well, I mean, the kicker is that they're told you'll get $10,000 worth of free silver. What they're not being told is they're going to pay $80 an ounce for their silver, not 24.
That's right.
Or 25.
And they're going to be paying 30% premiums in gold bullion.
Yeah.
Not 10.
Sometimes even higher than 30%.
Absolutely.
I've seen some craziness out there.
Yeah. So call us, give us a chance to explain the math to you so at least you go into it armed and ready and with the right questions and terminology.
That phone number, if you'd like to discuss your personal portfolio, is 800-525-9556. If you'd like more info, you can find us on our website at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as Tori mentioned, definitely give us a buzz. We'll be happy to talk with you, your family, friends, anybody we can about your precious metals portfolio. Thanks for listening and have a great week.